Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So if you grew up in my era, at some point, you likely experienced a DARE presentation at your school or, maybe at a club or something. Now, imagine for a moment that the DARE guy shows up and, he emphatically talks to the class for like an hour about resisting drugs. Don't do drugs, right? This is your mind on drugs. And then as he's heading out the door, he leaves a bag of heroin and some syringes on the table. That's basically what Jerome Powell did at the Fed meeting last week. He talked all hawkish, and then he tried to lower expectations for future rate cuts, even after the Fed cut rates and announced an end to balance sheet reduction. You see, the Fed is a drug pusher. The economy is addicted to the drug, which is easy money. And for all of the posturing about how, we're going to keep this party down, we're going to keep it down low, the Fed is supplying the drugs. The pusher is pushing more drugs into this addicted economy. It'd be just like the DARE guy showing up and handing out drugs at the DARE presentation. So, basically what the Fed is doing, it's cranking up the easy money party. Right? Here we go, party down. But talking like, don't indulge too much. Okay, so before we get any further into this, I want to thank folks for taking a little bit of time and listening to the show. It means a lot to me. I say this every week. I know there are all kinds of things out there vying for your attention, things to read, listen to, watch. Thank you so much for taking a little bit of time to tune into the Midweek Memo. You could do me a favor. You could help me grow the show. Share these episodes on your social media platforms. Give us those 5-star ratings. Go to your podcast platform and write a little review. It helps our reach, and it'll ultimately make the show better. So if you would do that, I would say thank you. And again, thanks so much for listening to the show. So back to the Fed. The FOMC, Federal Open Market Committee, voted 10-2 last week to cut interest rates by another 0.25%. The federal funds rate now sits in a range between 3.75 and 4%. And by the way, from a historical perspective, that's not very high. Now, I think even more significant is the fact that earlier in October, Powell hinted that the central bank might end balance sheet reduction, and the FOMC followed through. It announced an end to quantitative tightening as of December 1st. So in practice, what this means is that the central bank is going to stop reducing its holdings of treasuries and mortgage-backed securities. It's going to maintain the size of its balance sheet at the current level. And significantly, in order to do that, the Fed is going to have to go back into the market and buy treasury bonds to replace the ones that mature and roll off of the balance sheet. So what it had been doing is when these bonds matured, they were just letting them go. They weren't replacing them. So the size of the balance sheet was shrinking. Not doing that anymore. And what that means for the bond market is we're going to have basically artificial demand created by the Fed. The Fed is going to be buying treasury bonds. This is going to raise the price of treasury bonds. And conversely, it will suppress the yields. It will suppress interest rates, and it will allow the federal government to borrow money cheaper than it otherwise would. I talked about the significance of balance sheet reduction at length in the show a couple of weeks ago when Powell announced the possibility of ending quantitative tightening. So I'm not going to rehash that in depth, but just understand that this is arguably a bigger deal than the rate cuts. It signals an end to any pretense of an inflation fight, even though price inflation is actually going up if you believe the CPI data. I'm going to dig a little deeper into the balance sheet here in a minute because I think it is a prelude to more money printing. And I'm not alone in this. I'm going to explain that here in a minute. But anyway, I want to just cover a little bit more about what went on with the Fed meeting. Stephen Myron, he cast a dissenting vote. He was the recently appointed Fed governor by Donald Trump. He indicated that he wanted a 0.5% cut, so he voted no because he actually wanted to cut deeper. On the other side of the coin, Kansas City Fed President Jeffrey Schmidt voted no. He signaled the opposite. He didn't want any rate cut at all at this time. But the vast majority of the committee said, hey, let's go ahead and cut rates again. The official FOMC statement acknowledged, quote, inflation has moved up since earlier in the year and remains somewhat elevated. And yet, they eased monetary policy anyway. The committee stated that downside risk to employment rose in recent months. So it shows you that while they're still acknowledging, concerned about price inflation, they're also worried about the employment side of the coin. In other words, they're worried that the economy is getting a little bit shaky under the weight of these higher interest rates, which again, from a historical perspective, aren't really all that high. So basically what happened is Powell and company filled up the punch bowl, cranked up the easy money party, but then the Fed chair then tried to talk the giddy party goers down by tempering expectations for a December rate cut. Yes, I do realize I mixed my metaphors there between alcohol and heroin. Same difference, same concept. Party down, boys. But that's because the Fed just aggressively eased monetary policy despite persistent inflation. That's why Powell is trying to talk everybody down, right? In a sane world, the central bank would be holding rates higher to strangle inflation once and for all. It might even be hiking rates at this point. But we do not live in a sane world. We live in a world with what David Morgan calls a debt black hole. It's this massive level of debt, government debt, national debt, consumer debt, corporate debt, all of this debt that was incentivized by decades of exceptionally easy money by central banks around the world. So we've got this giant debt black hole. David Morgan calls it a black hole because it's impacting everything around it. Its gravity is sucking everything into it. We have this black hole. We have all of this debt, and the economy cannot function normally because of it. So you've got the Fed intervening and tinkering with interest rates to kind of try to navigate around this massive disruption in the economic universe. The fact of the matter is, we live in a world with a bubble economy, a debt economy, created by decades of easy money that cannot function even in a modestly higher interest rate environment. And I'll say it again, interest rates right now aren't historically high. I say this a lot on the show. We have a Federal Reserve Index. It's run by the Chicago Fed. It's called the National Financial Conditions Index. And from a historical perspective, monetary policy right now is loose. And it has been loose this entire time. And yet we're making it looser. Okay, this is really, really key to understand what's going on with gold and silver and with the markets in general. You have to grasp what is going on with the Fed. So Powell knows this, right? He has to at least talk like a central banker worried about inflation, even though he's cranking up the inflation machine. Going into the October meeting, most analysts expected the Fed to cut both this month, which is last month in October, and then again in December. But Powell said we shouldn't just assume there's going to be further easing in the final meeting of 2025. Quote, in the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Powell also indicated that there is a, quote, growing chorus, unquote, among the committee members to, quote, at least wait a cycle before cutting again. So, they left the heroin on the table, but they say, don't party too hard because you may not get more heroin in December. But you might not. Regardless, Powell's jawboning worked. Traders lowered the odds for a December cut from 90% to 67% after Powell's post-meeting press conference. And I think even more significantly, the stock market sank in disappointment. I think this is also part of the reason that we've continued to see gold selling off, gold and silver both, because, there's less expectation for rapid rate cuts. Now, what happens in reality, who knows? But this is what Powell is saying. He's trying to create this uncertainty, this impression, so people don't get too high on the heroin that it left on the table. And I think it's nothing but talk, right? Fed officials can say all kinds of things. They do say all kinds of things. Open mouth operations, that's part of monetary policy. But it's really important to pay attention to what the central bankers do, right? What it did was cut rates and ease monetary policy in an inflationary environment. And the FOMC has no clue what it's going to do in December because it's effectively flying blind with the government shutdown or limiting the release of data. When asked about the December cuts, Powell conceded, we just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving in. So, that's a fancy way of saying we don't know what we're doing. We have no clue. We're flying by the seat of our pants here. And of course, they can blame it on the government shutdown and the lack of data. But even when they have data, they still don't know what they're doing. So Powell also claimed, and this is a good one. Powell said inflation away from tariffs is actually not so far from our 2% goal. We estimate people have different estimates of what that is, but it might be 5 or 6/10. And so if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4%, in that range, something like that. So that's not so far from your goal. But look, no matter how Powell tries to parse and spin the CPI data, inflation is increasing. And this additional cut, coupled with an end to quantitative tightening, is going to accelerate that trend. I think Powell's comment about being close to 2% is really telling. I think we're about to do away with the 2% goal. 3% is close to 2, right? 3 is not so bad. We've been at 3 for a while. Let's just go with 3, right? Ryan McMakin over at the Mises Institute thinks that's exactly what's happening. And he recently wrote about it. I'm going to read this. It's kind of a lengthy passage, but I think this is key, and I really can't say it any better than he did, so I'm going to just read this. Quote, this new measure, and he's talking about measuring price inflation without tariffs. He said, this is, however, nothing more than a political ploy used to explain away rising prices so the Fed can claim that price inflation is really close to 2%, even if the federal government's own official numbers say otherwise. The Fed might as well go back to claiming that price inflation is transitory because of Putin's price hike. Tariffs don't cause inflation in the technical sense, of course, but in an environment of monetary inflation, tariffs do often contribute to upward pressure on prices of imports and import-dependent goods. So, what Powell is doing here is simply inventing a new number that excludes some higher prices from the CPI and PCE in order to create a narrative in which the Fed has steered price inflation back to 2%. Once we look past this ruse, it's likely we're witnessing the Fed give up on its 2% target in real time. Now, this is key. This is back to me talking. That was McMakin. This is me. There's nothing magical about 2%, right? 2% is a made-up number. If you ask any economist, why is 2% the ideal inflation target? They can't give you a reason. They might try to make up some BS, but there is no reason. It's literally made up. It's basically the same as when the government told you needed to stand 6 feet apart during COVID. They've admitted now they made that up. Right? That wasn't a thing before COVID. They just made it up. And they just said it. And so it is. And that's exactly why 2% is the ideal inflation target. They made it up. And I think, quite frankly, it's because 2% is a number that is pretty significant inflation. You think about it, that's 10% every 5 years. But it's not high enough that you really notice too much. And now since we're basically at 3%, and we've been at 3% for well over a year, we're getting used to 3, so let's just go with that. Here's the key. Understand this. Inflation is the plan. 2%, 3%, heck, they'd go to 5% if they could get away with it. Devaluing the currency is part of the process of maintaining big government. It is a feature of the fiat money system. It is not a bug. This is the plan. They have to monetize the debt to keep up the borrowing and spending. They have to keep borrowing and spending because we all want big government. So this is what we get. This is why I always say you need to have real money. There aren't many guarantees in economics, but I can almost guarantee that your dollar will buy less next year than it did this year. If you save in dollars, you might as well take a few $100 bills and just throw them in a fire every year, because that's in effect what you're getting. Now, speaking of real money, there was a time when U.S. quarters, dimes, and half dollars were actually 90% silver. That changed in 1965 thanks to Lyndon B. Johnson. But you can still find those pre-1965 quarters from time to time. And if you do, the silver value right now is worth well over $8. You used to be able to find those quarters and dimes out there in the wild, but you really can't much anymore. It's very, very difficult to find them. I remember back in the 80s, we used to actually go to the bank and like get rolls of quarters and try to find the silver ones. Hard to do these days. Most people are holding on to those because they're real silver. They're worth way more than a quarter. But right now, you can get these 90% silver quarters, dimes, half dollars over at Money Metals for 5 cents under spot for a limited time. This is unheard of. This is the best way right now to get silver. And with silver back down under $50, I would argue that this is a buying opportunity for silver. I wrote an article this week kind of explaining why I don't think that the bull run for silver is over yet. I'll link to that in the show notes page. But right now, 5 cents under spot for what a lot of people call junk silver. Of course, it's not junk. So check that out. You can call 800-800-1865 and talk to a Money Metals precious metal specialist, or you can go to moneymetals.com and just search for junk silver and you'll find that. But a great deal, a great way to save in real money that is not going to devalue. The quarter is not going to buy as much in 5 years, but the silver in that quarter is going to keep right on maintaining its value. So, I mentioned that I think that the end of balance sheet reduction is setting the stage for something bigger. Well, what is that, you might ask? Well, I'll tell you. I think we're about to go back to quantitative easing. Now, what is quantitative easing? Well, it is basically the Fed going out into the market and buying treasury bonds and mortgage-backed securities, holding them on its balance sheet. When the Fed buys assets, it does so with money created out of thin air. Those assets go on the balance sheet, and the new money gets injected into the financial system and ultimately into the broader economy. This is the process known as quantitative easing, often shortened to just QE. So when the Fed reverses the process and it shrinks its balance sheet, this is called quantitative tightening, and it pulls liquidity out of the financial system by reducing bank reserves and shifting government debt financing to the private sector. This tightens funding conditions and market debt. It's effectively deflationary. It decreases liquidity. It makes it more difficult to get loans. It raises the cost of money. It is not stimulative to the economy, and it tends to be deflationary. It pulls that liquidity out of the system. That's why we've been doing quantitative tightening now for a little over 2 years. That's why the Federal Reserve raised interest rates. It needed to contract that liquidity to try to pull some of that inflation that it created during the pandemic and even going back to the Great Recession out of the economy. Now, while Powell and company would never admit it, the central bank has no choice but to end balance sheet reduction right now due to the federal government's borrowing and spending problem. Now, they're going to tell you, oh, yeah, we think that the balance sheet is at the ideal level right now for the liquidity. BS. They are doing this because the federal government needs them to do it because it's got to keep borrowing and spending money, and interest rates are far too high for the government to continue doing that. We paid over $1 trillion last year in interest expense alone. Biggest spending category that the federal government has now, except for Social Security. So, in effect, the Fed supports the government's borrowing by creating artificial demand for treasuries, by purchasing bonds and holding them on the balance sheet. As I've already mentioned, this drives prices higher, it drives the bond yields lower, and it lowers the U.S. government's borrowing costs. That's why they do it. If the Fed wasn't holding on to so much U.S. debt, Treasury interest rates would be substantially higher than they are now. So, we might be paying $2 trillion in interest expense every year. So an end to quantitative tightening makes sense given the federal government is paying more than $1 trillion in interest expense right now. You can kind of understand why they want to do it. But we also have the inflation problem, right? So this goes back to this catch-22 that I've been talking about for almost a year now. The Fed needs to simultaneously cut interest rates to deal with the debt and to deal with the debt black hole. And it also needs to raise interest rates to deal with persistent price inflation. It can't do both. It had to pick something. It picked inflation. Again, inflation is the plan. So while an end to balance sheet reduction won't inject newly created money into the economy, it is going to reduce the number of bonds the government has to sell on the open market, thereby easing supply, raising treasury prices, and putting downward pressure on yields. That's why they're doing it. So simply ending balance sheet reduction, though, might not be enough. Given falling global demand for treasuries and persistently high interest rates, the central bank may have to relaunch quantitative easing in the near future to press its thumb harder on the treasury market. And in effect, this would be a return to money printing. Now, this isn't just Mike the gold bug crank who's thinking this. I'm not the only person who thinks that QE is going to resume in the near future. The Telegraph, relatively mainstream British publication. The World Economy editor, his name is Ambrose Evans Pritchard. He recently wrote an op-ed warning that the U.S. Central Bank, quote, is preparing the ground for a rapid return to net bond purchases, deeming it necessary to ensure sufficient liquidity for the financial system. In other words, it's preparing to go back to quantitative easing. Now, they're not going to call it quantitative easing. Evans Pritchard said they'll call it open market operations, and they'll sell it as a technical adjustment to manage bank reserves and the plumbing of the credit markets, or, some BS like that. No matter what they call it, it's still quantitative easing. It's still the same net effect. It's still money printing. And we've been down this road before. So to really understand this whole thing, we need to go back and kind of look at the history of quantitative easing. What are its origins? Where did it come from? Well, it started after the 2008 financial crisis, right? We had just seen these big bank failures. The mortgage market was burning up. We were in the early stages of the Great Recession. The Fed had cut interest rates to zero for the first time ever, but that was not going to be stimulative enough, and they knew it. We needed more stimulus. So Ben Bernanke, who was the Fed chairman at the time, launches quantitative easing for the first time. They actually ran 3 rounds of quantitative easing during the Great Recession era. Now, at the time, this was a big deal. It was literally turning on the money printing presses. Some economists were concerned. So Ben went to Congress to justify the move. And as he's testifying before Congress, he acknowledges that quantitative easing is an extreme monetary policy. He admitted that. But he said it was necessary because of the crisis, right? Whenever the government wants to do something that's way out of whack, they'll invent a crisis or point to a crisis or take advantage of a crisis. What was it that one dude said? Never let a crisis go to waste. I think it was Rahm Emanuel. So yeah, we had a crisis, and he assured Congress that the Fed was not monetizing the debt. He was very emphatic about that. Now, let me pause here and explain that term. What do we mean by debt monetization? Well, it's exactly what it sounds like. When the Fed goes out and buys these bonds, when it expands its balance sheet, it's not using money that it already has. It's literally creating money out of thin air. It would be like if I had a checking account with a zero balance and I could just go out and write as many checks as I want to. That's what the Fed does. So when the Fed buys these bonds, it's creating money. It injects it into the financial system. It's effectively turning the debt into money. Thus the term, debt monetization. Bernanke said that's not what was happening. He said that the difference between debt monetization and this quantitative easing policy was that the central bank was not providing a permanent source of financing. He said that the treasuries that the Fed was going to buy would only remain on the Fed's balance sheet temporarily. He assured Congress that once the crisis was over, the Federal Reserve would sell those bonds that it bought during the emergency. Of course, that never happened. I mean, they tried, sort of, kind of. But they waited 7 years. The Fed didn't hike rates from zero until December 2015. So for 7 years, we had 0% interest rates. That's insane, right? And yet we have a lot of people that kind of came into the financial world during that period, and they're the professionals out there. They're the guys and gals on CNBC and Fox Business right now. They don't know any better. They think zero is normal. They grew up in this era of extraordinary loose monetary policy, and they think it's normal. It's not. So one hike in 2015, then they had one hike in 2016, not exactly an aggressive tightening policy there. They finally got serious, kind of, in 2017, and they hiked rates 3 times, and they started balance sheet reduction at that point. Lasted about a year, maybe 2 years. In the fall of 2018, everything went to crap. The economy started getting wobbly, the stock market crashed, the financial system started getting out of whack. So what did the Fed do? Well, abandon rate hikes, and then they cut rates 3 times in 2019 and ended balance sheet reduction. This was before COVID, mind you. I've said for a long time that I think the pandemic bailed out the Fed. The Fed needed to pump air back into the economy. They needed to shove that easy money back out there because, after a decade, the economy was addicted to it. And so they started doing it in 2019. They tried to pretend like they weren't. They downplayed it. Oh, this isn't really quantitative easing. It was definitely quantitative easing, right? But the pandemic gave them the excuse to double down, right? It gave them the excuse to go back to zero, to do QE again for real. And so during the pandemic era, the Fed expanded the balance sheet by another $5 trillion. Boy, you talk about blowing air back into the bubbles, right? So we never reckoned with all of the malinvestments and problems caused by the easy money decade after the Great Recession. We never cleansed that out. And then we just doubled down and added on top of it with the pandemic. And here we are today. So after the pandemic, of course, we got the price inflation, and then they tried to say it was transitory, and then it wasn't transitory anymore. So they hiked rates, and, they started balance sheet reduction. And, the Fed has lopped about $2.4 trillion off the balance sheet since it started quantitative tightening. And that sounds kind of impressive, but it doesn't even represent half of the increase during the pandemic alone, right? And Powell said there are no plans to reduce the balance sheet back to pre-pandemic levels. So much for Bernanke's promise. This is debt monetization, pure and simple. Professor Tim Congdon from the Institute of International Monetary Research said the Fed is, quote, aiding and abetting the monetization of America's deficits. Congdon said about 2/3 of the U.S. national debt is being monetized in one form or another. Think about that. We have this massive debt, and we have the central bank that's basically just turning this debt into money and injecting it into the economy. This is what I call the inflation tax. Right? You always have to pay for government spending one way or another. They're going to take it with real taxes, or they're going to take it with inflation. They're using inflation. About 2/3 of the U.S. national debt is being monetized. This is why prices keep going up. Congdon said, quote, the U.S. authorities are incubating another spasm of inflation a year or two hence, risking a repeat of the great monetary error made during the early phase of COVID. They seem to have learned nothing. He's right. I say this all the time. Quantitative easing and rate cuts, that's the fork the Fed knows. That's what it's going to do. Evans Pritchard, the guy that wrote the op-ed for the Telegraph, he compared this situation to the Roaring '20s. And of course, we know how that turned out, right? Quote, "Forgive me for being an old cynic, but I would suggest that America is heading into an irresponsible financial boom akin to the final blow-off of the Roaring '20s and the Roaring '90s. The debasement trade is young yet." So in other words, all of this monetary malfeasance is going to blow up more bubbles. It's going to make the debt black hole bigger. And at some point, there is a reckoning, right? It's not just that these interest rates incentivize debt and create this debt black hole. When you have the Fed tinkering with interest rates, artificially suppressing them or artificially raising them, when you detach money from a free market, you're going to get malinvestments. The economy gets out of whack. That's why we have recessions. This is the Austrian business cycle. This is what we can expect. And we have this cycle. You know, the Fed blows up the bubbles with the easy money. Then it has to take the easy money away because of inflation. And then the economy collapses because it's addicted to the easy money. So they have to give the easy money drug back. Eventually, the drug addict is going to overdose and die, right? This is not sustainable. So while Powell and company would never admit it, the central bank has no choice but to end balance sheet reduction due to the federal government's borrowing and spending problem. And for the same reason, I think QE is going to be back on the table within the next year or two. And when Bernanke claimed that the central bank wasn't monetizing the debt, he was either hopelessly naive or he was lying. They have to monetize it. That's the only way this is sustainable. And even at that, it's not sustainable forever because at some point, the world's going to go, you know what? We're not going to subsidize this debt anymore, right? We're already seeing it. We're already seeing a kind of a pivot away from treasuries, a wariness of U.S. debt, de-dollarization. That's all part of this equation. Now, remember, properly defined, what is inflation? Inflation is an increase in the money supply, an increase in the supply of money and credit. What does all of this easing do? What do rate cuts do? What does an end of balance sheet reduction do? What would quantitative easing do? It increases the money supply. We've seen the money supply increasing for over a year now. The money supply is now larger than it was during COVID. This is inflation. Inflation is the plan. No matter what they say, this is what they're doing. They're doing inflation. And what happens when you have monetary inflation? Well, you get price inflation. You also get asset inflation. You want to know why the stock market keeps going up and up and up? Part of the reason is inflationary. All of this easy money has to go somewhere. It goes into consumer prices. It goes into asset prices. Why are housing prices still high? Price inflation. This is the reality you have to live in. This is why so many central banks are buying gold right now. This is why pretty much everybody in the world, except for Americans, are buying gold right now, right? The World Gold Council released the third quarter demand data last week. I'll link to an article on the show notes page. I won't go through everything, but the short version is gold demand grew by 3% year on year in Q3. It hit 1,313 tons, and it was the highest quarterly level in history. Not really surprising given that, gold is at historical highs. Third quarter demand was even more impressive in dollar terms. So when you, take those physical tons and then increase the price dramatically, we had a 44% increase in the value of demand to a record of $146 billion in the third quarter. And this was primarily driven by investment demand. In fact, jewelry demand has been hit hard by the higher prices. Now, here's the crazy thing. The only region with a decline in gold bar and coin demand in the third quarter was the United States. Just 7 tons. It was the lowest quarterly total since the 2017-2019 trough. According to the World Gold Council, U.S. demand picked up in September as the price broke through the $4,000 level. But by and large, American investors from the physical side have sat out this gold rally. Now, if you're one of the people out there that's buying these dips, you're probably pretty smart. Now, to be fair, I can't blame folks for booking profits, right? We see, $4,500 gold. We see silver over $50. I can understand why people would say, I want to lock in these profits. But over the long haul, you want to hold on to your gold and silver when inflation is the plan, right? If you save in dollars, your wealth is being eroded every single day by design, right? 2% doesn't sound too bad every year, but again, in 5 years, your dollar's lost 10% of its purchasing power. So it is significant, and your dollars are being eroded away. As I said earlier, you might as well just take a few $100 bills out of your savings and just throw them in a fire. That's what you're doing. You want to have real money. You want to take advantage of buying opportunities. Sure, if you need to book profits, no problem. If you need to take some of that cash and buy stuff, that's fine. But you don't want to just hold on to dollars for the sake of holding on to dollars. If you're going to sell your gold and silver, you have to ask yourself, what am I going to replace those with? So, perfect time to call Money Metals at 800-800-1865. Talk to a precious metal specialist. They can help you figure out, how will gold and silver fit into my investment plan? How will it fit into my portfolio? Can I use gold and silver in my IRA? Yes, you can. Is there a way to buy gold and silver over time? Yes, there is. We have an installment plan that will allow you to build a precious metals portfolio over time. A lot of options. So take the time, chat with the precious metals specialist. If you don't want to talk on the phone, you can go to moneymetals.com, chat with the precious metals specialist on chat there. Or if you want to just buy, go to moneymetals.com, pick out what you want. We'll package it up for you. We'll ship it straight to your home. Or you can also store your metal in our state-of-the-art bullion vault in Eagle, Idaho, which is a pretty awesome place, a very safe place to store your gold and silver if you don't want to hold it at home. But do it today because, again, your dollar is going to be worth less tomorrow than it is right now. That's just the reality. It's not something you can vote away. It's the world we live in. So, that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, sign up, get on our email list, join the over 1 million people who are on that list. Of course, you can subscribe to the Midweek Memo podcast on your favorite podcasting platform. If you haven't done that already, do that. When you do, you'll also be able to tune into our Market Wrap podcast every single Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people in the world of gold, silver, economics, and investing. Again, thank you so much for listening to the show. It really means a lot to me. Give us those thumbs up, those likes, those reviews. We appreciate that as well. And in the meantime, I hope you have a fantastic rest of your week, and I will be back again next Wednesday.